this computer. Okay, so let's get started. We are in week 10. We are learning chapter 10. Okay, so let's take a look at this first question. The first question is that using the tax shield approach, okay, tax shield approach, calculate OCF given the following information: sales, costs, depreciation, and tax rate. Okay. Have you watched my lecture video yet? Did you get a chance to watch the lecture video I recorded for chapter 10? So if you did, give me a thumb up. No, you haven't? Okay, so in that lecture video, I explained the 3 different approaches to calculate operating cash flow, okay? So one approach is called the tax shield approach, okay? So under this approach, the operating cash flow that equals sales minus cost, okay? And this cost, you have to exclude non-cash items like depreciation. You have to exclude non-cash expenses, okay? Like depreciation. Okay, make sure this one is kept. And then this one, you have to multiply. You have to multiply by, I'm going to use a different color, by tax shield 1 minus T, which is T is the tax rate, okay? And then you're going to add depreciation expense times tax rate, okay? Why it's like this? In my lecture video, I explained from, because initially the operating cash flow equals EBIT plus depreciation minus taxes, right? So everything started from here. This is the definition, okay? So everything started from here. Under certain condition, when I use different other variables, I'm able to get a formula like this, okay? So this is the calculation using the tax shield approach. Why is tax shield approach? Because in this calculation, we are using the tax rate, okay? So if you know this, then everything is very straightforward. For sales, that's the 885K. Cost, that's 670K. And tax rate, that's 35%, 1 minus 35%, and plus depreciation. So depreciation, the information given here, depreciation is 120. So 120,000 and times T, that's the tax rate, 35%. Okay, so why don't you do a quick calculation and see what you got? Okay, the answer is 181,750. So why don't you do a quick calculation, see if you get this number, okay? And yeah, if you got this number, just give me a thumb up, okay? Thank you, Oriana and Godfrey. You guys both get this number, good. So if you want to understand, oh, thank you, Dante, why the formula like this, in my lecture video, so for each week, I'm trying to post a lecture video under the week tab. So watch that one. There are two other approach. One is called a bottom up. Another one is called a bottom up. The other one is called a top down, I think. Yeah. And then text shield. So there are three approaches, right? Okay. Does anyone have any questions on this one? Are you good for me to move on? Give me some up. If you're good for me to move on, give me some up. Okay, awesome. Thank you. Okay, now let's take a look at the second question. So this question, I want to spend some time, okay? Question 2, a project will produce operating cash flows, okay, 57,000 a year for 3 years. During the life of the project, the inventory will be lowered. So that's a decrease by 10,000. Accounts receivable will increase by 20,000. Accounts payable will decrease by 5,000. Okay. So what happened is when you have a project, right? To sustain the project, you need to have probably higher level of working capital, right? So therefore, that project may help you reduce the inventory, but at the same time, help you reduce the inventory, help you reduce the payable, but at the same time, your accounts receivable increased. So for example, why things like this happen, right? Suppose I have a project, okay? In order for this project to work, okay, I have to pay the suppliers quickly enough, right? Otherwise, they will not work with me, right? So that's why my accounts payable will decrease, okay? And this project, let's say, it helped me to sell inventory faster, right? So your inventory is lowered, okay? Your inventory is lowered. And then maybe you are targeting the clients that will pay you slow, right? So therefore your accounts receivable increased, right? What I'm trying to say is that when you have a project, it can affect your different assets account or liability accounts. Okay, the project requires the purchase of equipment at an initial cost of 90,000. The equipment will be salvaged at the end of the project, creating a 17,000 after-tax cash inflow. So initially, you have to spend $90,000 to buy the equipment, but after 3 years, at the end of the project, you are able to achieve the salvage value. That is 17,000 after-tax cash inflow. So at the end of the project, net working capital will return to its normal level. Okay, what is the net present value of this project given a required return of 12%? Okay, so I'm going to give you 5 minutes. I want you to think about this question and try to put down some information, right? Instead of just listening to me, right? So I want to give you 5 minutes. You analyze this information and then put something down on your paper, see what you got, okay? I give you 5 minutes. So try to put anything down, right? Just whatever things you know, you understand, right? So 5 minutes, okay? Okay, did you get a result? Did anybody attempted to get the result? What's your net present value? Did anyone try? If you tried, give me a sum up. Oh, you are just waiting for me. Okay, so how should we start? Can anyone tell me? How should I start? Figured out the total cash flow? Okay. Cheryl, what do you mean by that?
I don't really know if what we're gonna do with the decrease inventory, increase accounts receivable and the payables. So I thought that will contribute to the total cash flow.
Okay, yeah. So I'm going to explain this to you. Very good question. I'm going to explain this to you. So you purchase the equipment, right? So for 90,000, that's the cash you had to pay, right, upfront. But you also need to deal with your working capital, right? So you want to know that with the project, do I need more working capital or do I need less working capital, right? Because if you need more working capital, you have to invest it right away, right? Just like you purchase the equipment. So now let's take a look, okay? So what is the net working capital? What's the net working capital? Can anyone tell me what is the net working capital? How do you calculate this? This question should be fair, right? So net working capital, how do you calculate? You should know. You definitely should know this. Net working capital. How should we calculate net working capital?
Is it asset minus liabilities?
Thank you, Cheryl. Yeah. So it's current asset minus current liability. Okay. Okay, so in this case, I see inventory, I see accounts receivable, and I see accounts payable. Which are these ones are asset? Which one is liability? There are three accounts. Which accounts are a current asset?
Current assets, accounts receivable.
Yeah, AR.
AP, accounts payable is the current liability.
Yeah, APA. What about inventory?
Current asset.
Yeah, current asset, right? Okay. Okay. So before the project, my net working capital, WNWC, equals AR, I use B, that's before, inventory, AR, accounts receivable, B means before, plus inventory B minus accounts payable B, right? That's before. Now you need to have a project, right? So now with the project, the project will require different levels of the asset liability, right? So with the project, so your net working capital, W, equals AR W plus inventory. W means with project, W minus accounts payable, W. Okay, now, yeah.
Since it's a decrease in accounts payable, would we still subtract it or would we add it?
So we're going to talk about it later, but for now, I'm using the formula, right?
Okay.
Right now, I'm exactly following the formula, right? You may be one step ahead of me. So, but that's good. Yeah, but I'm going to talk about it, okay? So before project, W net working capital B equals accounts receivable B plus inventory B minus accounts payable B. With project, you just need to replace the subscript with W, right? In replacement of B, right? W, right? So now I want to know with the project how much the change, right? So I want to know the change. The change in net working capital due to the project is net working capital with minus net working capital B, right? Before. So I have this minus this, AR W minus AR B plus inventory W minus inventory B. And here, this is a minus sign, right? Minus AP W minus AP B. Is this clear? With these two equations, I take the difference between the two equations. Is this clear? Give me a sum up if you understand. 1, 2, 3. I did nothing. There are two equations. I take the difference of the two equations. So I subtract the left side and I subtract the right side. Okay. Good. Yeah. So now you tell me AR minus AB, right? So how much accounts receivable has increased? Can you tell me what is this number? AR minus AB. So how much? Yeah, 20,000. Thank you. So this number is 20,000. Okay. Plus inventory. How much inventory has changed? Lowered 10,000, right? So that means lowered means inventory W is less. So this one here would be a negative. You add a negative 10,000, right? Because here is an increase, but here is a decrease, right? Decrease, then this is a negative number. So you minus, so accounts payable, that's also a decrease, okay? So decrease by 5,000. So in the bracket, it's negative 5,000. Okay, so now if you get rid of all this bracket, so that become 20,000 because it's a plus. So this negative is out. So minus, minus, double minus. So that's a plus. So the change in working capital is actually 15,000. So with the project, my working capital is $15,000 more, right? So not only you have to spend $90,000 to purchase the equipment, you also need to spend $15,000 to inject into your working capital, right? So does this make sense? Okay, 1, 2, 3. Does this make sense? Awesome. So now you understand why I'm doing this, okay? Now, at the end of the project, if you take a look at the question here, at the end of the project, net working capital will return to its normal level. So how does that affect my cash flows at the end of the project? So now we are saying initially you have to spend $15,000, right, to make your net working capital higher, right? But at the end of the project, the net working capital level will return to its normal level, just as before the project. So now, what's the implications to the end project cash flow? Who knows that? Yes, very good, Godfrey. So that's gonna be so now you spend $15,000 initially. So at the end of the project, you are able to get that cash back because you release that $15,000 cash from the working capital, right? You don't need the actual working capital anymore because the project is ended, okay? In the beginning, you have to spend the $15,000 to inflate that working capital, right? So that it's fit for the project. So that's kind of your expenditure in the very beginning, cash outflow. But at the end of the project, that working capital level return to its normal. So that would release that $15,000 cash out, right? So in the beginning, it's a negative 15,000. At the end of the project, it will be a positive $15,000. Does this make sense? 1, 2, 3. Okay, very good. Now, this is the major part. I think your student may confuse. So I went through this, the definition of the net working capital, and I calculated how much net working capital is required. Okay, so this is my timeline. So I start doing this timeline. So I have year 1, that's now, and year 0, and year 1, 2, 3. Year 0, you need to have an initial cost negative $90,000 to purchase the equipment. Well, you need to spend $15,000 to increase the working capital. Okay, so in total, your year-end expenditure is negative $105,000. In year 1 and year 2 and year 3, you have an operating cash flow. That's all the same, $57,000. Okay, they told us the project will produce operating cash flows each year for 3 years, right? At the end of the year, at the end of the project, the equipment will be salvaged. Okay, you can sell the equipment, so that would creating a after-tax cash flow 17,000. So you're gonna receive this after-tax cash flow 17,000. And don't forget, because at the end of the project, the net working capital will return to its normal level. So that net working capital, the $15,000 cash flow will be released, right? So that's the 15,000. at year 3. So then I know initially 105K, year 1, year 2, 57K. Last year, it will be a little bit more because of the salvage value of the equipment and also the cash flow released from the working capital, 17,000. So in total is 89,000. Okay. With this information, why don't you use your and then you know the required return is 12%. So with all this information now, why don't you use your financial calculator to calculate what's the number you get, net present value? Okay, Godfrey get for 54,681. Okay, thank you, Godfrey. We'll just wait to see what numbers other people are getting. Anybody else? I don't know the result. I don't remember the result. Okay, so I have 2 students get the same number, so I trust that's probably the correct number. So let's take a look. So I have CF0. I'll press the CF button. CF0. That's the current year 0 cash outflow. Make sure you put a negative number here, right? It's cash outflow. And then you have the first annuity, 57, and that's for 2 years, okay? And the last one is 89K. And you want to make it clear, I equals 12. And then you compute net present value, 54,681.35. Good job. Good job, everyone. You guys get this number. If you're happy, give me a thumb up. We can move on. You have any questions, let me know. Okay, so no question. I'm gonna move on. Okay, so this question is about EAC. Okay, EAC. What is EAC? It's called equivalent annual cost. So this is often referred to equipment assets. Okay. Question 3. The equipment below is required for a business. Assume each will be replaced as it wears out. The required retail return is 15%, ignore taxes, okay? What is the equivalent annual cost, EAC, of machine A? So forget about machine B. So we are only focused on machine A. Okay? So if you really think about how much does it cost you, right? So equivalent annual cost. So the idea here is your cash flow is like this. At the very beginning, how much do you spend on this equipment A, machine A? Can anyone tell me? At the beginning, okay, how much you will spend on machine A? Yeah, $200,000, right? And then the life of the machine is 8 years. How much do you spend each year to operate it, to operate a machine? How much did you spend for machine A every year? Operating cost, right? You purchase the equipment, that's the upfront cost. But to run the equipment, to run the machine, right? There are operating costs, right? Maintenance, right? Whatever, it's just the cost associated with running the machine, right? So how much is that for machine A? Yeah, $15,000, right? $15,000. Yeah. Okay, so that's the two figure. But did you notice it's interesting, right? Because the timing are not the same, right? So $200,000 is at the very front. And in the next 8 years, every year is $15,000, right? But this is one way to think about your cost of owning the equipment. Another way to think about is, what about equivalent annual cost? If I imagine that I'm owning this for 8 years, right? How much does it cost me every year? If that's an equal number, right? If it's like annuity, right? I know in this case, it's not annuity because the initial investment, $200,000, is different from $15,000, right? So it's not a pure annuity. But, right, let's think about the situation. What annuity amount will achieve the same net present value, right? That's the question we want to work on. We want to know if this is annuity, right? What would be the net present value, right? What would be the net present value? Okay, so how this works? First, let's calculate the net present value. Can anyone tell me what's the net present value for machine A's cost? Well, year one is easy, right? Year one is very easy. Year one is just negative 400,000, right? That's your cost, right? Year one, that it's year zero. Sorry, year zero is negative 200, right? So that's easy. But what about this? What about this 8 years? So 1 to till year 8, right? So this is annuity. Each year is 15,000. So each year, so I'm gonna use that. I'm going to use that annuity, ordinary annuity formula. Does anyone remember what is the formula? See, I remember it. I'm not sure if you guys remember it. If you remember that, give me a thumb up. The formula for the present value formula for the ordinary annuity. So it is a division, and in the denominator, that's the R. Okay, and in the numerator is a difference. So 1 minus something, minus this is a 1 plus R, 1 divided by 1 plus R to the power of N. And this one, so this would be the annuity factor, right? Does this make sense? Do you remember this? Give me a thumb up if you remember this. So this annuity factor is a division. So in the denominator is R. In the numerator is a difference, 1 minus factor. This one is 1 over 1 plus R to the power of N, okay? So this is the annuity factor. What is the payment? So you are paying 15,000. So that's the equal amount. And then times this annuity factor, okay? So in this case, we know R equals 15%, N equals 8, right? This is N, 8 years, and R is 15%. So why don't you calculate this net present value, okay? Calculate this net present value. and tell me once you have a result, okay? So when you have this calculation, you can also use the present value as negative 200,000. Future value, so that's gonna be 0. Payment, so that's negative 15,000, and n equals 8. I and y, so that's gonna be 15. So you calculate the present value of the annuity. Sorry. Calculate your present value of annuity, and then you add 200,000. That's going to be your net present value. Okay, so Oriana have 177,440.4. I don't know the result. I will see. I will wait to see another number. See if students have some other numbers. Negative 26720. Okay, 267,200. Okay. Okay, let's see what I got here. Okay, I didn't calculate. Okay, and now, can you calculate the annuity factor? Can anyone calculate this? This annuity factor? Okay, Oriana, you got the same result. So help me calculate the annuity factor. Oh, good. So we know this net present value is negative 267,309.2. Okay, so that's the net present value. What about the annuity factor? Okay, 4.48. Okay, now use net present value divided by the annuity factor. So use your net present value divided by your annuity factor. That is your equivalent annual cost, EAC. So EAC equals your net present value of all the cost divided by the annuity factor. What do you get? Anyone? It's just a division. Shouldn't take that long. Okay, so 59667.37. Okay, so you are close enough. The result should be this one, negative 59,570. The reason why you get this is because you didn't keep all the decimals, right? For the annuity factor, you didn't. The 4.48 is approximate. You probably should keep more decimals to make the result more accurate. Okay. So then you may wonder, right? So basically, we are saying initially negative 200,000, and then year 1 through year 8, each year is 15K, right? So that's going to be equivalent to every year is negative 59,570. This annuity, year 1 to year 8. Does this make sense? So the actual expenditure cash flow is the top one, right? In the beginning, year 0, you spend $200,000, right? And each year after, the operating cost is 15,000 for 8 years, right? So that's the actual cost cash flow. But we're trying to think about what if, right? What if, let's say the company have a deal with you, does not require you to have upfront payment of $200,000. You are leasing it, right? For example. So then every year for the 8 years, you're going to pay a little bit more money, right? And we figured out to have the same cost, which is the net present value. The annuity amount, the payment is negative 59,570, right? Does this make sense? So 1, 2, 3, give me a sum up if you understand this. Does anyone have any question? Okay, so pretty clear. Figured out what's the cost cash flow, and then calculate net present value, and now calculate annuity factor. So net present value divided by annuity. Okay. Did anyone ever wonder about the depreciation? So if you think about $400,000 divided by 8, right? So that'll be 25,000 a year. Did anyone ever wondered about that depreciation? So you never think about that, and why? Why is irrelevant depreciation? Why the depreciation is irrelevant? Yes, that's not the cash flow, right? The cash flow is the $200,000 upfront the payment, right? So the depreciation is not cash flow, right? Okay. The real cash flow is you paid all in one time, right? But for accounting purpose, you amortize it over 8 years to recognize the usage of the asset, right? But from the cash flow purpose, you paid the $200,000 upfront, right? Okay, can I move on? 1, 2, 3. Give me a sum up if you allow me to move on. You are my boss, right? So you say yes, you can move on, and then I will move on. Okay, good. So let's take a look. This is the last question for today. So question 4, a project will increase sales by 640,000, and the cash expense by 370,000. The required equipment will cost 600,000, belongs to a CCA class of 25%. The company has a marginal tax rate of 35%. What is the value of the depreciation tax shield in the second year? Okay, in the second year. So what's the depreciation tax shield? So the depreciation tax shield is the CCA times tax rate. Okay, so that's the depreciation tax shield. So you know tax rate, so that's the 35%. So you just want to calculate CCA for the second year, right? We are wondering about the second year. Every year the CCA may be different, right? Unless it's a straight line kind of approach. Otherwise, CCA is most likely to be different year by year. So they are being specific which year we are doing the calculation. So let's take a look. So year one, your base, right? This is your cost. So this equipment cost you 600,000, right? So that's year one, 600,000. And the rate of the CCA rate is depending on which asset class it belongs to. The question is pretty clear that the asset class has a 25%. So times 25%, that's a quarter. So it's going to be 150,000. And year two, so you already recognize $150,000 CCA. So for year two, the starting point will be the difference, 600 minus 150, right? Because that's the part you already recognized. So your cost base is actually lower, right? So 600,000 minus 150,000, you have 450,000 times 25%. So the CCA for year two is 112,500. And so that's the CCA times tax rate, 35%. The result is 39,375. Is this correct? Is my calculation correct? Okay, Dante said, why don't we times it by 1.5? Very good. That's good job. Okay. So the current tax rule is really about the policy is trying to help the corporations to speed up the CCA recognition, right? So the way they do it is they allow you to, they allow you to have a larger cost base by applying 1.5. So that's called a 150% rule, okay? For year one, only for year one, okay? But it's funny though, because I think maybe the textbook is a little bit outdated, okay? Prior to the 150% rule, the CRA doesn't want the corporation to recognize. Usually you buy asset, right? Probably you buy it on average, right? You could buy it January 1st. You could also buy it on December 31st of the year. But on average, we can think about statistically, on average, it is the middle of the year, right? So therefore, they treat the first year as half a year. So what happened is in the previous tax laws, prior to the 150% rule, I'm doing tax, right? Tax is very complicated. So prior to the 150% rule, they are actually using a 50% rule. Why? Because, like I said, when you purchase an asset in a year, it could be January 1st, it could be December 31st, right, for the year. But on average, if you think about it statistically, right, you consider all the business, all the purchases, most likely maybe it's like a maybe middle of the year. So therefore, they consider only half of the year is considered into the calculation. So what happened is they use the 50% instead of 150, right? The 150 is the most recent. But too bad the textbook is not updated, right? And so that's why the answer is this. Because I tried both ways, because I was going through the 150 rule, but I get a different result. So the result is this result. And then I use the 50% rule, I achieved the same result, okay? For the purpose of this course, you are going to use 150% rule, okay? For the purpose of this course, you use 150% rule. Okay, so does anyone have any question on this one? Are you okay with this? Give me a sum up. 1, 2, 3. Awesome. Okay, so that's what I can offer. If you have any questions, please let me know. Send me email. So I will try my best to help you. Okay. So class is dismissed, and if you have a question, you are welcome to stay around.